Markets woke up from the long holiday weekend on the wrong side of the bed as most indices were down over 1% in the pre-market session. However, as the day went along, we saw a lot of resilience out of the bulls, and what was interesting about it is a lot of the worst areas of 2022 were the ones that led the way higher here today. Things like communications, technology, discretionary all did quite well, whereas we saw those areas that had been doing well earlier this year do very poorly today. Things like energy and utilities really struggled here today. So it was kind of one of those opposite days out there, but did make for some interesting trading. And we did find that while most of the indices closed near the highs of their session here today, none of them could break free from their strongly bearish postures quite yet. So we'll keep our eye on that. But in the meantime, there's been a lot of activity. We spent a lot of time in tonight's video talking about commodities, talking about interest rates, how that can affect our thinking moving forward. Then we'll get into our trade application example where I wanted to focus on one of those utility stocks that rolled over with the sector here today with a bearish trade idea. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 5th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. We'll also give you the heads up on which stocks are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. And I really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join us at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. Let's get our S&P 500 heat map pulled up here to get a lay of the land as we kind of start off our holiday shortened week here in the United States. I hope all of you had a good 4th of July weekend and an opportunity to unwind and relax a little bit. Of course, hearing about some of the tragedy there in the Chicago area with a 4th of July parade, so that was quite unfortunate. But hopefully rest of you around the other parts of the country were able to have some nice R&R there. Anyway, as we kick things off here, you can see that it was quite an interesting day on Wall Street, where it was kind of the, as I alluded to on Twitter here just a moment ago, opposite day. I happened to see a post from somebody else saying that all of the strategies that were up so far year to date were down today, and all of the strategies year to date that were down were up today. And so I thought immediately of George Costanza, for those of you who are Seinfeld aficionados, and the whole opposite day there. So anyway, today kind of felt like the opposite day in the stock market when we had some of the best performing sectors like energy and also utilities get absolutely annihilated. You can see that it was a clean sweep in both of those sectors. That's pretty rare to have all stocks in two whole sectors in the red, and most of them pretty notably. It wasn't just a gentle pullback like ConocoPhillips here, down about 7% here today, as an example in the energy world. If we came down and took a look at some of the utilities, there's Exelon down 5% here today. So that's obviously a very big move for utility. And those two had really been the superstar sectors thus far on a year-to-date basis. More so energy with more absolute returns, but even utilities have been a very strong sector on a relative basis compared to other sectors out there as well. So both of them got damaged quite dramatically here today. You also saw that those defense contracting areas like Raytheon, Lockheed Martin, Boeing, General Dynamics, L3 Harris, Northrop Grumman, those areas got blitzed pretty hard today too. Remember, that was another area that's done reasonably well in 2022 with everything that's going on with Russia, Ukraine. And even some of those healthcare areas that had been holding up a bit better. Bristol Myers, Johnson & Johnson, Pfizer, United Health, they were all down today. And so there was a handful of other healthcare areas that stood up a little bit better. We actually focused on healthcare in my dividend growth investing class today, where we got a chance to buy a stock for the very first time in that class since we started those classes here at Market Scholars. So over 4 years, and to my recollection, I don't think we bought that particular company back when I was teaching similar classes at TD Ameritrade. I don't have my notes from back then, so I can't say for certain, but I don't recall it specifically. So just goes to show you that when the markets get in a more violent type of a move and there's major sell-offs that are taking place, opportunities do emerge, and sometimes those opportunities are quite fleeting, and they only appear once every several years. And so anyway, that was kind of an interesting discussion we had earlier today. For those of you that are premium members, feel free to check that out. The recording is posted. But other than those areas, you see that we do have quite a bit of green on the screen as well. And importantly, the biggest squares and rectangles tended to be more in green here. Like your Apple was up 1.89% today. We had Microsoft up over 1% today. Nvidia had a pretty strong day, up over 3%. Alphabet had a huge day. It was up 4%, and Facebook or /Meta, that was up 5%. Amazon was up 3%. Tesla was up nearly 3%. Even Home Depot, Nike, that had gotten beaten up last week, they're back up today. So a lot of those areas in consumer discretionary, in communication services, and technology all did quite well today. And remember, those have been some of the worst areas in the market so far this year. So a huge snapback rally taking place within some of those specific groups. In fact, another thing I was going to mention, let me come over here to the charts. And let's just pull up chart 3A just to get a lay of the land. I wanted to show you ARK. Some of you recall that we had a conversation in this presentation maybe a month or so ago about ARK. In fact, I still see my line drawn down below here that I think I drew during that presentation, so some of you will recall that. But the reason I drew that was because of where some of the lows were. In fact, I might need to go back a little bit further than 3 months. Let me pull up a 6-month chart here. Yeah, that's kind of where the line must have come from, somewhere in that general area. There was a bounce that took place here back in May, and I believe that was just a little bit above. Let me go back to the COVID time period. So let me go back to the 3-year chart here real quick. There it is. Back here on ARK, and so this is Kathy Wood's fund, right? It's been kind of in the blast zone of the market drop in the last year or so as a result of a lot of highly speculative securities that she was interested in, or they, I should say more appropriately, over at ARK Invest were interested in some of the really exciting, disruptive, innovative types of companies. They bottomed out in this ETF, ARK Innovation Fund, at about $33 back here in 2020. This is March of 2020, so this would have been right during the worst part of the COVID drop right here. And then they went on one of the most epic runs you will ever see out of a supposedly diversified fund. You can take that concept a little bit too far, I suppose. But point being, there are dozens of stocks in this one ETF, and it went up tremendously. I mean, at a breakneck pace. But of course, we now know what the opposite side of that was as well. There was a lot of froth in the price movement there, and we had this great unwind that took place over the last year and a half or so. And so we kind of identified this almost round trip that we took in one of my presentations with you guys here in the Market Outlook video maybe a month or so ago. And I had mentioned that somebody that was bold could very well try to buy this ETF, place their stop loss down here below this blue line representing where the old low was, and perhaps have some upside potential with that. And at that time, it was trading at around $35, and you can see now it's up to $45. So there's been a whole $10 per share since that point. Now, unfortunately, I was not bold enough to take that trade here in the video, but I did mention it for those of you that are maybe a little bit more aggressive with your trading than I am. And that would have worked out reasonably well. The other thing that's kind of interesting to me is that if you were to go back, so let's go away from the 3-year chart right now. Let's go back to the 6-month daily chart on ARK. And one thing I've been kind of sharing with my premium members that might be useful for some of you watching this free video as well is there has been a bit of outperformance in the ultra short term here in ARK. Now you can see it was up 9% today, so that's of course a huge day for this particular ETF, and it closed effectively at the highs of the day. The close was indeed the basically 1 cent off the high of the day. So it was the high was 44.98. It closed at 44.97. So that's a strong sign there as well. It almost felt like there was maybe some pent-up demand as we kick things off for this trading week here, again with yesterday being a holiday here in the United States. But one thing that I've been sharing with some of the other folks in my other classes is, what's interesting about ARK here is that it did not breach its May low in this additional pullback in June. Notice that the low tag is still back here under May 12th candle, and it did not get transitioned over to this candle here on June 14th. The low that day was 35.65. So it basically came within, 50 cents or so. So it got awfully close to breaching that low, but it never did. Now, it's not the end of the world, or not the biggest deal in the world, I should say, if it was happening in a vacuum. But we have to remember what was also happening at the same time with the rest of the market. Here's the S&P 500. And notice that where we were back here in the middle of May versus where we were in the middle of June, we easily broke down to new lows on the S&P 500. And again, going back to ARK, we did not do that. We hit our low here back in the middle of May, but we did not hit a fresh low here in the middle of June. And so it kind of gave you some sensation that it was trying to hold the line here. Now, it's not a guarantee that it's going to go up or anything like that, but it is a recognition that those areas that had been kind of blitzed for a year straight seems to have stabilized to a degree. And if you look at some of the key stocks within that area, one of them that I tend to think of when it comes to that fund is Zoom Video. And it's kind of the same thing. Zoom Video is actually starting to perk up here just a little bit. So anyway, I wanted to point that out because you just never know when some insight like that can help your next best trade. And it is possible that we're starting to head back towards some of those more speculative areas, not necessarily because they've somehow magically become better companies, but perhaps because they've already taken their lumps, right? Some of these stocks are down 70, 80%, that sort of a thing. And you can only go down so far, and you usually don't go down in a straight line. So maybe there's going to be some relief rallies in some of these most speculative types of areas. Another one that's been kind of working here in the last month or so is Chewy, that pet online dog food delivery company that kind of gained some notoriety there during the coronavirus time period. So some of those names that were once superstars that fell dramatically out of favor seem to be stabilizing here a little bit more. Part of the reason behind that, by the way, we talked about this in my dividend growth investing class today as well. And of course, we've been sharing this with you here in these market outlook videos. But, there has been a continued decline in interest rates here over the last 2 weeks. It seems like one of the stories of 2022 so far has been the skyrocketing interest rates. And that's, I think, fair. What we've recognized with interest rates is one of the most violent moves you will ever witness in the government bond yields. Basically, you're talking about record-breaking pace, what we witnessed in just 6 months' time. And we eventually topped out up here. Remember, on TNX, on the Thinkorswim platform, you just move that decimal point over to the left one. So basically, at the high of this candle right here, it meant that the highest that the 10-year Treasury yield got to was 3.48%. So very close to 3.5%. And notice where we're at all of a sudden. We've fallen, and not only that, but put in kind of a lower high. And we've fallen all the way down here to close today at 2.8%. So we went from basically 3.5% to well below 3% in just 2 or 3 weeks worth of time. In addition to that, notice how today we have a red moving average on TNX. This is a 30-day moving average for the first time since back here. And really, we've only had a couple of instances in the entire last 6 months where you've had a red moving average. So this is somewhat noteworthy here, and this is a pretty far amount below the moving average that it's trading as well compared to some of these other times. Now, these other times did find some stabilization, so who knows, maybe it can happen again here as well. but it does kind of feel a little different, right? Remember a couple of weeks ago, I went out of my way to spend a big chunk of my presentation with you guys going through the commodity 12 grids, which is not my typical routine here, but I thought it was important that particular day because it felt like there was a change afoot that very day. And that was one of the key themes here today as well. Commodities got absolutely blitzed. So, we want to make sure we're pointing out some of these important movements for you guys in case you're not, seeing it on your own. And I'm sure you're curious what's catching David and I's eyes as well during the day. And, this is one thing that it has definitely caught my attention here in the last 2 or 3 weeks is what's happening with 10-year Treasury yield. And remember, it is said that the more long duration assets that either a stock or a financial asset class is, the more that it has interest rate sensitivity. And for a bunch of this year, we saw interest rates going up and up and up and up and up. And of course, that was when we saw growth stocks get absolutely crunched. And now we're seeing kind of maybe the opposite of that. If there is a sense that interest rates can't just keep going up forever, and this is about their topping out point, you might get a little bit more enthusiasm around some of those innovative, disruptive growth stocks that are out there because of how the cash flows and everything else discount back to today when you use your 10-year Treasury as an input. So anyway, something to take note of and to keep in the back of your mind here, because if you think that this TNX is going to continue to break down the way that we've seen in the last 2 or 3 weeks, then one way that you might be able to do well by kind of playing that theme is by taking a look at some of those really vastly beaten up growth stocks that I had mentioned previously. A lot of those from the ARK funds, as an example, could benefit if interest rates do start rolling over in a bigger fashion. Anyway, let's go ahead and take a look here at our breadth numbers, and I'm going to come over here to the Visualize tab. Let's go ahead and pull up the S&P 500, and actually I need to come over here to the watch list first and then come down to public. Where is it? S&P 500. There we go. And it was a pretty split day. Now, obviously we saw the breakdown a little bit ago when I was showing you the S&P 500 heat map, and we saw that the biggest squares and rectangles were mostly in the green, which is why you see that on a day like today where we had pretty flat performance by the end of the day, you could achieve that even though less than half of the stocks closed in the green today. A lot of the most important stocks did manage to close in the green, like your Apples and Microsofts of the world. So anyway, there was more selling stocks today than buying stocks, but the ones that were bought have the bigger market caps, and so they pull a little bit more weight. But it was a pretty split day, all things considered, right down there, fairly close to a 50-50 split. And again, energy and utilities really stood out as you couldn't find any place to hide in those two sectors here today. If you had any exposure to those sectors, you likely lost money as a result of that. But of course, you have to keep in the back of your mind that earlier this year it was exactly the opposite, and those were the areas that were kind of saving you compared to a lot of the other sectors as well. Let's go ahead and take a look here now at our 4 grid. This is chart 4B for those of you that are premium members following along at home. And as you can see here, we remain with strongly bearish postures on all 4 of these major U.S. equity indices. We know that immediately because the background colors of the charts under today's candle are that dark pink color. Remember, that occurs when either the green line, the intermediate line in the market forecast, is either in the lower reversal zone or it has rolled over and is declining and is somewhere between 50 and 20. In both of those instances, it would be that dark pink coloring telling us that we've got a strongly bearish posture. Now, keep in mind that today looked like it was going to be a pretty ugly day at the open, which was a little bit interesting in its own right because last night before I went to bed, I went, and checked out some of the fireworks off my deck, and, finished up the holiday festivities and tried to, call it a night. And right before I went to bed, I snuck a peek at the futures, and the market was actually up pretty nicely. I'm thinking, oh, okay, good. Maybe we'll have a positive start to the week as we kick things off tomorrow morning. Well, by the time I woke up this morning, it only took about 8 hours, and markets completely erased all of the gains in the futures. And actually, the futures were down like 1% at some of the points during the morning. And so it actually turned out looking like it was going to be a terrible day for the stock market. So I think that's one of the positive undertones of this market right now, is that there was some resilience here today. You can even see that when you're looking at each of the 4 candles of these 4 different indices, we did basically close either at or near the highs on all 4 of them. So while the intermediate posture still has its struggles, because as you can see, we still have work to do. These charts do not look great as they are all trading below their falling 30-day moving averages, and none of them have a series of higher highs and higher lows. So there's still a lot of work to do. And from an intermediate perspective, they are considered to be bearish. But in the short term, there is some semblance of, an effort being made by the bulls to try to scoop up value where it presents itself. And remember what I had mentioned, it was either in this presentation on Thursday or maybe in one of my classes, but in one of my presentations somewhere along the way, I had mentioned those statistics. In fact, I think it was in this video, now that I'm recalling it, on Thursday, because that was the day that the first 6 months was over. That was June 30th, the last time I did the video. And I was going through a bunch of those stats that I found on Twitter, and one of the more interesting ones was how terribly the first half of the year was, and how most of those instances that were similar to what we experienced this year did have snapbacks in the second part of the year. The snapbacks were not strong enough to offset the first half of the year's losses, but in many of the cases, they were still reasonably substantial. And so, just a reminder that because things feel like they're filled with despair right now, doesn't necessarily mean that we are in a one-way flight lower or anything along those lines. We've got opportunities to have tradable bounces along the way, and you just never know what may happen as we head into the midterm elections. A lot of times governments do what they can to stay in power. And so, there's maybe incentives that get pushed into the market, or some efforts made here or there to stimulate things. And if that's the case, then you never know if that might positively impact things there. So anyway, appreciate the opportunity to trade within these markets and understand that they're not just one way in nature. Maybe we could get a couple of months of upside there. Let's keep our eye on that possibility. But for right now, the charts are still giving us the strongly bearish mindset right there, or the posture, I should say. All right, let's go ahead and pop right back on over here now to the, let's actually go over to the internet here briefly. I always like to get a chance to say thank you to everybody who clicked like for me there the last time I did the video. 116 of you did so. Thank you very much. Remember, anytime we're up and over 100 likes, I'm happy to do a full-length video for you, including a trade application example. If we're under 100 likes, then I would just end up doing a 15-minute review of the 4 major indices with no trade review. So let you guys kind of vote through your likes there. If you like these longer form videos, just take 5 seconds out of your day. Click like for me there on Twitter. If you prefer the quick hitter videos that can get you on your way a little bit faster, then no need to click like, right? It's always up to you anyway. Just like you have every ability not to click like or to click like, we have every ability to do the video or not do the video, right? It's all volunteer basis. So we'll let you decide to see if you are enthusiastic about us spending the time that we do making these videos for free for you here on YouTube. Also, as I mentioned earlier today, I taught my dividend growth investing class where we focused on a matchup of 2 number 1 safety scores in the healthcare sector. And that's specifically from Value Line Research. So if you're interested in that and you're a premium member, check out my recording. David taught his directional option strategies class. And so make sure you check that out as well. Tomorrow I've got my factor-based swing trading class that'll be kicking off here at about 11 a.m. Eastern time. And then David's going to get his afternoon rolling with options inventory trading at 2 p.m. Eastern Time. So it should be another great day of content here for us tomorrow. Also, while we're at it, I see some of these popular recent posts over here, and I should mention them as well, as I was busy putting together content over the holiday weekend. I know many of you have family get-togethers and different things like that, so you might not have seen that I posted it. So that's why I have this opportunity here with the platform that I have in this video to make you aware of that in case you're interested. Remember these two things that you see over here, the dividend stair-step sector statistics and the dividend growth investing increases. Those are both available for anybody on our website. And so feel free to check that out. I've got them, I think, pulled up in a separate tab up here. This first one will basically give you the statistics on a sector-by-sector basis as far as where are the best opportunities for dividend growth investors for new money at this moment in time. And then this other post here will basically just announce what companies managed to raise their dividends last month. And last month was a very quiet month. We find that in the dividend growth investing world, most companies have their dividend increase announcements take place at the beginning of the year when a lot of boards of directors are meeting for different annual meetings and things like that. But right now we're kind of in the dog days of summer, so to speak, and so not quite as much activity there. But nonetheless, sneak a peek at that and see if there's anything of interest for you to investigate or perhaps put on your watch list for potential future purchase if you are a dividend growth investor for the long term. All right, let's go ahead and pop back on over here to the charts. Real quick, just to make sure we formalize it, because I always like to verbalize it as well, because I know sometimes you guys are watching these videos on your cell phones, and so you can't see the numbers nearly as good as folks that are watching it on a big screen TV or on their desktop monitors or what have you. So the S&P 500 was up today, just barely. It was up 0.16% today. The Dow Jones was down 0.42% today. The NASDAQ Composite was up 1.75 today, so it was our biggest winner. Again, a lot of those growth stocks, innovative, disruptive companies, they were the ones that led the way today, so it makes sense the NASDAQ Composite was our leading broad index. And then the Russell 2000 did have a fairly decent day as well. It was up 0.79%. But again, the takeaway is, despite the rallies in some of these indices here today, we remain with strongly bearish postures for the time being, and all four of them are trading below falling 30-day moving averages. Let's take a look at some 12-grid analysis now, starting with chart 5A. And as we're looking at this here, you can see that we do have a smattering of green showing up on the left-hand side. Remember, those are the charts that are considered to be bullish according to the intermediate line on the market forecast technical indicator. We actually talked about one of those on Thursday's video that I recall specifically, the long-term treasuries, because I was pointing out how for the very first time in many months, TLT had a green moving average, meaning that price was above a rising moving average. Now, in the couple of days since, this is a little bit of a rarity, but we continue to have a couple of relatively decent up days. But because of the way that the 30-day moving average is calculated, you're always kind of lopping off a day from 30 days ago and then adding the newest one. Just the way that things kind of shook out in the calculations, the moving average actually started falling down a little bit again. But remember, the longer it can stay above the moving average, the greater the chance is that that moving average will start bending higher. And I would anticipate that there's probably a decent chance that that can occur here with TLT, given what we've seen here more recently. So remember the conversations I had with you last week, and then a month or so ago as well, when we were talking about Tina versus Terra. There was once no alternative. Now there are reasonable alternatives, and you are finding that investors continue to buy bonds here in the last 2 or 3 weeks because the interest rates were reasonably respectable, and you can actually lock down some reasonably decent income over 3% in those areas. Now you can't today, right? Because as I mentioned before, TNX slipped down below 2.8%, but prior to this little downdraft we've had, all of these days over here, if you were buying long-term government bonds, you're getting 3% rates on those. And so anyway, you can see TNX is back to a strongly bearish posture, red moving average as I mentioned before. Here's the spillover in oil and commodities in general that I somewhat referenced earlier in the presentation, but here it's maybe a little bit more obvious. Oil was down 8% today. It got hammered. In fact, I think they were saying on business television that crude oil got below $100. Let me just double check that. Yeah, it actually is trading at $100.93 as we speak. Remember, this is the futures contracts I'm looking at here. So this is actually changing hands as I'm speaking here. But in the rollover of the future contracts from day to day, we actually did close below $100 officially on, kind of what you would call yesterday's contract. So anyway, really big meltdown there in the commodity world. You can see gold also suffered pretty violently. It was down over 2%. So really ugly activity there out of both of those. And you can see what the charts look like. Gold has been a bit of a house of pain for a while. That one is one that we have intentionally stayed away from. There's been a couple of times where I'm like, I'm getting a little bit warmed up to it. I'm getting a little bit more used to the idea of maybe dabbling in gold, but fortunately I never did because had I'm sure we would be in the house of pain in those particular trades. With oil, we've been kind of looking at oil from the sidelines, but in these trades that I've presented to you here in this particular market outlook video, I don't recall that we've actually done any oil trades. So while we've recognized that that's been one of the stronger areas, in a way it was almost too strong. So that way, by the time we were looking at it, we kind of missed some of those trades that would have been taking place. But in hindsight, that might have actually benefited us because this is unwound very, very quickly here. So most of the bullish trades we've been doing in recent months have been in some of those beaten up areas where we've had oversold cluster signals and things like that. We haven't really been dabbling all that much in oil, but we definitely have some exposure to oil in my other classes, and we're feeling some sting in those areas without a doubt. You can see that the US dollar is part of the reason behind why commodities are dropping like a rock right now. US dollar went absolutely flying here today. Now you look at this and you say, well, that's only a 1.43% move. Is that really a big deal? When you're talking about the world's most important and largest currency, yeah, it's a huge deal. Absolutely huge. In fact, they were saying that I believe it was like the first time in 20 years that the US dollar specifically versus the euro is nearly at parity. And I think they were saying it was like 2002 the last time that happened, and we're basically right back there right now. So I suppose if you're an American and you're looking for a holiday abroad, there's no time like the now, I suppose, because your dollars will stretch a little bit further overseas, and that is going to be a painful reality for the commodities right now. And you can see that they are reacting pretty negatively to a stronger dollar environment. Those commodities priced in dollars really rolling over aggressively here today, and kind of continuing that theme that I had shared with you there a week or two ago when we spent that time on looking at palladium and corn and wheat. Those things are just getting killed. In fact, let me go over there because I'm curious. I haven't looked at the 12 grid myself today, but maybe we can do that together just to kind of play a little bit of catch up and see where we've gone. And remember, at that time, I remember having the conversation with you guys. Coffee was the only one that was bullish, and it still is the only one. And so it's kind of interesting how that particular theme held as well. But everything else is strongly bearish, not even weak bearish, strongly bearish. And these things have absolutely just fallen off the map here. Many of them actually end up having some oversold cluster signals. As an example, natural gas has an oversold cluster signal. The commodities index, DBC, has an oversold cluster signal. Copper has an oversold cluster signal. It was down another 5% today. Corn was down nearly 5%, has an oversold cluster signal. And while sugar and cocoa don't today, they did, last week. And so, point being, it has been really ugly, really fast. in a lot of these commodities. Oh, by the way, silver, it looks like it has a cluster here today as well. So maybe there's a chance that they can try to get a little bit of a dead cat bounce, but that was the reason I wanted to spend the time with you that I did a couple of weeks ago on this particular 12 grid that we hardly ever review in this particular video. And the reason is because it felt different. It felt much more dramatic. It wasn't just your typical pullback like we experienced tons of times earlier in 2022. The commodities got absolutely smashed. They fell out of bed, and you can now see the aftermath of that. They're continuing to slide very, very aggressively. So maybe that will kind of help with inflation. Maybe that is part of the the recipe for recovery, right? It's hard for the economy to get its footing if commodities are just flying higher. And so, in a strange way, perhaps this is actually good price action for the rest of the stock market. Anyway, let's take a look at some sector analysis now, and let's do chart 5C, the U.S. sectors 12 grid. And as we're looking at this, you can see that we have just one green chart on the board, and that happens to be consumer staples. Not only does it have a strongly bullish posture according to the market forecast technical indicator, but you can see that it now also has a green moving average, and it joins only healthcare. Those are the only two that can make that claim as of this moment in time. So still a couple of more defensive areas of the market with staples and healthcare, but even when you look at those, it's hard to get excited about the charts from a trend trading perspective. They're both still in pretty sloppy charts at this moment in time. Maybe there's more opportunities from a more aggressive kind of swing trading mentality, but from a trend trading perspective, there's still a lot to be desired. And unfortunately, I wish I could say that some of the other charts were picking up the slack for that, but that's just simply not true. This has been an absolutely brutal year in the stock market. Actually the worst first half of the year in my entire lifetime, and these charts basically verify that. They confirm that, right? This is the way it looks in a really truly awful stock market. These charts in front of us represent the 11 different sectors that are out there, and none of them look particularly great, and a lot of them look downright awful, right? Energy actually ticked to a new 3-month low today. It was down almost 4%. It was down 3.97%. So it was the day's worst performer, and it did touch a 3-month low. And isn't that crazy? Because just back here on June 8th, less than 1 month ago, you were hitting multi-year highs in energy. And so you went from multi-year highs to 3-month lows in less than a month. That has been a very violent unwind right there. Now, in the second worst performing sector today was utilities. It was down 3.41% here today. And you can see that it now has a red moving average as well. It does have a light pink background color, so that is what represents a weekly bearish posture. But one thing that kind of caught my eye with utilities is it's kind of given me the impression that you have three separate kind of lower high areas, right? You had a high back here, you had a lower high, and you have yet another possible lower high. Now, if this reverses tomorrow, that all bets are off. But right now, it's kind of setting up that way. I was actually tweeting with somebody on Twitter over the weekend regarding utilities and talking about some of the statistics from a dividend growth investing perspective and how utilities were one of the most overvalued sectors out there from that particular analysis. And the other person, was mentioning that they were thinking about shorting utilities, and I said, well, I'm not so sure overvaluation is a reason to short a company, because overvaluation can lead to even further overvaluation. But in this particular case, if they did end up shorting them at the open this morning, they're probably pretty happy about that, because this is a very aggressive move on utilities. You don't usually see utilities move over 3% to the downside, but this is one of those rare days where that did occur. In terms of outperformers here today, it was those more speculative areas that I had mentioned before. Consumer discretionary led the way here today. Actually, I take that back. Just by the narrowest of margins, Communications led the way today. They were up 2.3%, and discretionary was up 2.2%. So very, very close in terms of percentage returns for those two. And then somewhat further behind it was technology, up 1.2%. All of the rest were in the red. Remember, it was the giants of the technology and discretionary and communications that we recognize on the heat map earlier, where you had Apple and Microsoft up out of the technology area, you had Facebook and Google up out of the communications area, and you had Amazon and Tesla up out of the discretionary area. So those mega caps really pulled a lot of weight here today for the entire market. But anyway, it was good to see those areas that have been really in that blast zone of the market for most of this year kind of help lead the way in today's trading for a little bit of a change of pace on opposite day. All right, let's go ahead and get into our trade application example now. And for that, I'm going to get started with, let me do this. I'm going to work a little bit backwards, and I'm going to show you a longer term chart first. And I'm going to bring up ticker symbol XEL. This is Xcel Energy. This is a company that is one of the main utility providers in the Twin Cities and other areas in the upper Midwest. I actually used to live in downtown Minneapolis for about 3 years myself, so I think I used to pay a utility bill to these guys. But anyway, they, like so many other types of utilities out there, have done really well, for all intents and purposes, in trading in recent months and even in some cases years. You can see this is actually a pretty strong 10-year chart here. Now you'll notice that where Xcel Energy is trading is up here in this orange zone. This is where we would identify an overvalued stock. Now again, as I mentioned before, just because something's overvalued, that's usually not a signal that you then take the trade based upon that. You want to take your trades signals based upon something that's happening more from a technical analysis perspective in the short term. But I did want to at least point that out because it helps kind of solidify the picture that I'm trying to paint for you here with this trade, because it will be a bearish trade. And I just wanted to identify that in this case, Xcel Energy has been a really good performing stock over the last decade. It's actually done too well, where it would not be an attractive long-term investment up at these levels. Remember, in the dividend growth investing classes, we want to buy them when they're down here in the blue zone. So like back here in 2015, we'd have been happy to buy Xcel Energy back here. But then it got into that overvalued territory. It's kind of stayed up there. Speaking of which, I should also point out real quick, because this is somewhat rare, and I did post this on Twitter already, and I know not everybody follows me on Twitter, so sometimes I need to bring them up here during my other presentations as well. But I did notice that Texas Instruments hit its blue line here today, this morning at one point, and then recovered after that, right? They're low, so if I hover my mouse over the bar, not a candle, but a bar in this case, you can see up here there's a bunch of different kind of abbreviations, and one of them will be L colon. I'm kind of circling it right now, so keep your eye on that L colon as I go back and I point at today's bar. And today's low, as you can see up there now, is 144.46. Now you'll notice in the blue label directly below where it says L colon, on the chart itself, where it says average high yield, this is usually a pretty attractive candidate for long-term purposes when it has a dividend yield of 3.18%. And in order to attain that 3.18% at its current dividend rate, it would need to trade at a price of 144.65. That's that second light blue label that you see right next to it there. So in other words, today's low was 20 cents lower than where you would need to be in order to get into that blue zone, and then it popped back out of it. So some of you who would have been quite nimble waiting for that moment, if you've been waiting for the last couple of years to buy Texas Instruments when it got back into the blue zone, you had your opportunity this morning, and it's definitely in a pretty significant downtrend like so many other semiconductors right now, so there'll probably be other opportunities down the road as well. But I just wanted to point that out because this is a pretty well-regarded tech stock in the dividend growth investing community, and today was a pretty special day because it hit that blue line for the first time in a couple of years. Anyway, back to Xcel Energy, which is the real trade application example I want to show you in tonight's video. Just wanted to reiterate that on a longer term perspective, we would view it as being somewhat overvalued up here in this orange area. Now, I also wanted to point out, let's go over here to more of an intermediate trend trading perspective now. So we're going to kind of advance our thoughts from a long-term dividend investor's perspective. Now let's talk about multiple months as a trend trader and see what we can learn from that. So I'm going to pull up the same ticker symbol, XEL. And here I wanted to point out, as it kind of loads up for me here, so it's going to take a moment, but first of all, you will see a red arrow appeared over today's candle up here near the 30-day moving average, suggesting that price is now below that moving average once again. So that could be, one thing that is a little bit more bearish about it. But really what I wanted to show you was down below here. There's these relative strength lines that we use in my Monday top-down trend trading class. And you'll notice that they have numbers embedded in the labels themselves. And it's basically a ranking system, and the numbers can go anywhere from 1 to 99. So it can't go below 1 and it can't go above 99. So those are kind of your upper and lower bands, so to speak. And you can see here that as a utility company, it still scores pretty well on a relative strength basis versus the general stock market with a 77th percentile right there. But notice versus the utilities sector and the electric utilities industry group, XL Energy now is below 50. So in other words, it's part of the underperformers, the lower half of the performers. If you think about everything that has a reading of 50 and above as being an outperforming stock within those categories, and anything with 50 or below being an underperforming security, that's yet another piece of evidence that suggests that maybe this one is not quite as strong or robust as traders would want. So that's another thing I wanted to share with you. And then lastly, let's go over here to our normal swing trading chart. This is chart 3A. And as we pull that up here, let's go ahead and pull up the ticker symbol again of XEL. And you can see here that with today's violent move, and this was a big one, right? It was down 3.77% today. It did switch the background color from light blue to light pink. And basically what that signifies in this case is that the near-term posture is now considered bearish. Now, not only that, but you can see that we've got a little bit of a bearish near-term divergence signal taking place here as well, because you had a high in the blue line right here. It looks like it was on June 27th. And then you had a lower high right here on July 1st. And the two candles associated with those two levels would be this candle right here that I'm circling and this candle right here. So in other words, price went up. In fact, straight up. It went up every single day in between those two levels at the same time that we had deterioration in the underlying technical indicator there. So this one would, be a fairly good example of a bearish near-term divergence signal. You can also see that we've pretty effectively engulfed the body of the prior day as well. So this would be fairly close to what you would refer to as a bearish engulfing candle, which is usually obviously bearish, as the name suggests. Just telling you that, hey, this probably got a little bit overheated to the upside. In fact, this thing was up 1, 2, 3, 4, 5, 6, 7, 8, 9 days in a row. Now, all it effectively did was unwind this entire meltdown where it was down almost 9 days in a row or whatever it was. But you can see that it stopped short of actually retaking those highs over here. So it has me wondering if all of these oversold cluster signals with these green dots kind of resulted in a reversion to the mean type of a move, which we see so often, but not a trend-changing type of a move. And once it got back to its averages area, which is why they call them 30-day moving averages, now this is an area where sellers have used it as an excuse to either lighten up on their holdings or perhaps take bearish outright trades. And that's effectively what I did in today's case. You can also see that the moving average color is red with price back below a falling moving average in this case. So what I did with today's, I looked at the options market initially, but this one as a pretty boring utility company. Remember, utilities are not the best sector to trade options on because not a whole lot of people are speculating in those areas, right? It's the tech stocks that usually have the best options liquidity out there. The more boring areas of the world, like utilities, usually have very few speculators that are involved there. So while I might have been able to force through a trade if I really wanted to, I opted instead just to do a very simple short selling technique on this one, where I sold short this security here towards the end of the day, so just under $70 per share, and I would put our stop loss above the candle of today and yesterday's highs, and then our price target where we want the stock to fall back to will be down here where this kind of horizontal line is, around $67, a little bit above that. And the other thing I wanted to mention is, remember, we're on the cusp of earnings season, and so I will keep my eye on this one as we head towards July 28th. If the trade is still live before then, there's a decent chance I would pull the plug on the trade before the earnings announcement, because I just don't want to risk a gap against my trade for some reason. But that still gives us, a good, 3 weeks or thereabouts to be in this particular trade, to see if maybe it can start rolling over a little bit more aggressively and work its way back down to some of those candles where it was trading earlier. So that was tonight's trade idea, based upon the bearish near-term divergence and the really ugly price activity in the entire utilities sector here today. Hope you enjoyed the analysis. If you did, I have one simple request. Take 5 seconds out of your day. Click like for me there on Twitter. Remember, you can always find that pinned to the top of my timeline on Twitter. Otherwise, you can use the built-in embedded widget on our website directly below where you're watching the video. And we really appreciate that, because that helps us get the word out about our business a little bit more, and somewhat incentivizes us to do these free videos, because, as I mentioned, they are a big undertaking, a huge undertaking, as a matter of fact. If you think that you typically only have like 8 or 9 hours in a workday, and 3 of them are carved out to do something completely free that we don't get paid any money to do, you have to think long and hard as to whether you can actually justify taking that much time out of your day. So I know for a lot of you, these are important videos, and you enjoy them, and you get value out of them. And again, the only thing we ask out of you in return is just simply click like for us there. That'll help us. It'll help you as well, because it'll teach Twitter your algorithms to send you more and more content that David and I produce, and hopefully that is useful for you as you become better traders and investors moving forward as well. So thank you very much in advance for your willingness to do that. And David should be back with you tomorrow for the video, so look forward to his analysis as well. And then I will see you all on Thursday, either in a short form video or perhaps even a longer form video like this one. And look forward to seeing many of you tomorrow morning in my factor-based swing trading class as well. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.